So let's talk about the impacts of climate risks on an organization, first from operational point of view, and then from finance point of view, from accounting point of view, right? So we have climate risk divided or categorized into two different categories. Number one is your physical risk, and second is your transition risk, right? So physical risks are, you all know about physical risk. We have floods, we have extreme weather events, like we have droughts in one summers in any country. Also, we can have wildfires. These are acute physical risks. These are sudden, right? And these are short term. They can happen tomorrow in some part of the world. And the chronic physical risks, which are long term events, for example, sea level rise. Sea level rise is continuously happening because of melting of glaciers, which, in turn is an effect or is an impact of temperature increase. So, temperature increase is also a chronic physical risk, right? Because it may not be impacting us today, but it will, I mean, a very high probability that it will impact, most parts of the world, say 20 years from now. And in some parts, it's still happening, right? Maybe one part of the year in summers, and we all are feeling the heat of temperature increase, the heat of sea level rise. Not in all countries at the same time, but yes, in some parts, right? So these are the physical risks, the physical due to physical events. And then we have transition risk. There are risks because if we want to avoid physical risk, right? If we want to avoid extreme effects, adverse effects of climate change, then we have to make very strict regulations. We have to make a technology shift to, a rapid technology shift to green technologies. Also, as consumers, as individuals, our preference should also change. And all these things, if you see in combination, they also form risks to these organizations from financial point of view. Why? Because if, say, one government is coming up with a regulation, it's a carbon pricing regulation, which says that if you're using, high greenhouse gas intensive technologies, machineries, traditional machineries, right, and high emitting vehicles, then you will be taxed as per your greenhouse gas emissions. You have to calculate your greenhouse gas emissions, and if it is above a certain threshold, then you will be taxed. So that is, from company's point of view, it is a risk, right? If such a regulation comes, because they will have to pay the tax, their revenues will come down, their expenses will increase, tax expense will increase, and so on and so forth. So this is also a risk. So transitioning to a lower economy, we will have to face these risks. And in my view, in my personal view, transition risks are better than physical risks. Obviously, transition risks can be, uh, in my view, and I think in general view also, can be forecasted or can be projected, right? Say in 5 years from now, one certain regulation will come. So you can be prepared for these transition risks. And these are the risks that, you have to face to be able to, achieve that net zero vision, to be able to, avoid the adverse impacts of climate change in the long term. So, from organization point of view, all these risks, physical risks and transition risks, they impact operations. Number one is asset damage. Asset can be your factory, your machineries, your equipment. If flood water enters your manufacturing unit tomorrow, right? Your manufacturing unit is situated in the floodplains, and if flood water enters, then your machinery will be impacted. It will get damaged. Your infrastructure of the factory will also get damaged to some extent. Your vehicles will get damaged, and other equipments, raw material will get damaged. So that's asset damage that, one maybe physical risk will do to a company. Operational disruption, because your production will be stopped if such a thing happens. So that's your operational disruption. You will be paying to your employees, to your workers, but they will not be able to work, or they will be able to work in a very curtailed manner, in a very limited manner, because repairs have to happen, machineries are damaged, so on and so forth. Supply chain shocks. So if you are a supplier to a big company and your manufacturing unit facility is damaged, how will you produce the products which you have to transport to that customer, right? So for that customer and also for you, your supply chain uh, has damaged, has got disrupted. This will have multiple impacts. Number one, next quarter results will reflect this because you will not be able to produce goods. That means your revenue will be impacted and your profits will be impacted. And also, in medium to long term, that customer can also drift away from you and can, pick another supplier instead of you because you have high profile, high risk profile. So the different visions, different aspects to understand these things. Then transition risk may lead to stranded assets because say if a policy comes, if a regulation comes in future in 2 years from now, it will say that you have to use renewable energy, you have to use high efficiency machinery, right? The latest standard of machinery, which means you cannot use old machinery. So then suddenly as the regulation gets active or be forced, right, your machinery will be of no value because you have to retire your machinery and you have to purchase new machinery which is allowed as per that regulation. So that old machinery has become a stranded asset. Okay, and then increased costs and taxes. Obviously, carbon tax is there. Other costs can be increased to comply with the regulations. Then market demand shifts. Obviously, your consumers they prefer sustainable products, more sustainable products. So you are producing products which are using high GHG intensive processes, machineries, and fossil fuel based electricity, etc. But so they have high carbon dioxide emissions, high CO2 emissions associated with your products, while the consumers have moved towards more sustainable products. So your revenue will be impacted and you will be subjected to penalties and other kind of impacts. Your consumers will go away. So there are a lot of ways these risks can impact your operations, and ultimately it will be reflected in your financial statements. Your financial statements are number one, profit and loss statement, balance sheet, and your cash flow statements. Your revenues will be impacted, they will come down, your profits will be come down, your margins will be disrupted. You will have to invest more money or you will have to do capex, capital expenditure, in order to keep up with the pace. You will have to replace all your old machinery with the new machinery, and that needs money. If you have money in your bank account, then you will use that money which is your money, so cash, etc. Otherwise you will have to take a loan to buy new machinery, to set up a new plant, and that plant has to be set up with all new machinery in order to say offset climate risk or to capture a new climate related opportunity. So the other impact on the balance sheet, if you're doing capex, right, your assets will increase. If you're taking a loan, your liabilities will also increase. So there are different aspects through which these climate risks impact your financial statements, like balance sheet. And cash flow is the liquid cash, is the free cash that you have that you can use if you want. Right now you can use it. So your operating cash flow will be impacted, your investing cash flow will be impacted, and your financing cash flow will also be impacted. And I have described, I have explained this in details in the detailed 1 hour video lesson that we have introduced in our end-to-end ESG reporting course, right? So yeah, this is the whole scenario, how it operates, and I hope you like it. It helped you in understanding the financial impacts of climate change. Thank